Day in what's been so far a very volatile session. With the S&P 500 down 10% since January 26, let's see what buying opportunities there are in the market. We're going to explore that with Jordan Stewart. He's a client portfolio manager at Federated Kaufman Funds. Welcome, Jordan.
Thank you.
And then before we get to your picks, and you literally mean picks, which we'll explain later, let's look at today's market action following yesterday when the market closed below that key 200-day moving average of the S&P 500. What do you make of this volatile session so far? Stocks modestly higher.
Sure, yeah, we think the market gave us an opportunity to buy. The fundamentals are still very strong in the economy. Earnings growth is accelerating. We expect this first quarter to be one of the best quarters on record. Earnings growth ranging from 10 to 15%. And the last couple days volatility has created an opportunity, in our opinion, to buy some. We're biased to growth managers, growth stocks, some names that can give you some of that E in your PE in your portfolio.
Okay, well, I'll take a look at those growth stocks later, but before that, Spotify shares a real splashy debut, rising about 26%, now valued at $30 billion in a direct listing at that. What do you think is going to happen as a result of the Spotify listing?
I think it shows that there's demand for growth stories out there. More growth in the FANG stocks have had their run, and I think investors have gone a little tired of those names in the last couple years and looking for new opportunities, names that companies that can control their own destiny, secular growth. Spotify's in a unique position, number one player in that streaming service that everybody seems to use. And they're growing users, they're growing paid subscribers significantly, and they have a trajectory kind of in the next 2 to 3 years. It kind of reminds me of Netflix about 5 years ago.
Are you adding it to your portfolio for your clients?
Yeah, we can't say specifically, but it's definitely a story that we like, a secular growth story, and we like the way that's trading today. That's for sure.
All right. Let's stay on the subject of technology stocks. The FANG stocks have really taken a beating: Facebook, Apple, Amazon, Sure. Netflix, and Google. But you say the real opportunities are in what you call the picks and shovels.
Sure.
Explain what you mean by that, and which stocks in particular.
So ever since tax reform, we hear CapEx spending is picking up. We hear that companies are going to be spending more because of the incentives that the new tax reforms created. And we think that actually the FANG stocks are going to be spending the most. The Facebook, the Apple, the Amazon. And where are they going to be spending that money? In data analytics, in data, big data, cloud, software. And that's where we actually think that you're going to see the next step of accelerating growth is some of these companies that are supporting that, the picks and shovels, if you will, for the FANG stocks. When we think CapEx, we think big, dirty value stocks, but we're actually thinking that the FANG stocks combined their CapEx spending will be bigger than 30 Boeings.
Right.
CapEx spending.
And where's that going? Which stocks in particular?
Well, we like Splunk and Red Hat. To make it simple, they're doing all that data analytics that you want to see. Facebook's going to have to spend more on protecting privacy and their data. They're going to have to use more Splunk and Red Hat. Amazon and Apple and frankly, for that matter, Walmart. How's Walmart going to compete with Amazon? They're going to spend on data. They're going to spend on e-commerce. They're going to be using a lot of these companies' software to make them more profitable, more efficient.
Even though Red Hat's trading at 68 times 12-month.
The business momentum is there.
That's not going to deter you. And the FANGs themselves, why not the FANGs? The valuations have come down.
Sure.
They're going to be big beneficiaries of the repatriation because of the changes in the tax law. Something that doesn't affect small caps as much.
Sure, and I'm not going to knock the FANGs. We own a lot of them in our large cap portfolio. But in order to maintain those multiples and maintain their growth rate, they're going to have to spend. They're going to have to invest. And we've seen it from Amazon, quarter after quarter, year after year. That's why we like some of these smaller large cap names that can support that growth.
All right. And finally, earnings season rolls around very quickly. We're in mid-April. So what happens to stocks then?
I think we're starting to digest, kind of this first quarter economic woes, a little bit of volatility in the market. I do believe that as long as this is an earnings-driven rally, that growth stocks will maintain their leadership. Obviously, we're growth managers, so that's where we're focused. But the demand for that earnings growth accelerating for the next couple years is going to be we think in growth stocks, tech, healthcare, and some consumer discretionary which is a pretty broad basket, but consumer discretionary, those who are investing in e-commerce.
And not roll over to value, which is lagged for quite a while.
We're growth managers. We're sticking with growth right now.
Okay. All right, thanks a lot, Jordan, for sharing your thoughts.
Thank you.
Our thanks to Jordan Stewart of Federated Kaufman Funds. I'm Fred Katayama, and this is Reuters.